Here live today for episode 159 on Canadian Mortgage Weekly. We're looking forward to sharing with you just how much longer interest rates will stay up for. I know it's not a really great title to see this morning as we're getting into a higher interest rate environment, but I want to get on here and just let you guys all know what I'm seeing in the market and what I think is going to transpire over the next few years. And it's really important to stay up to date with mortgage information, especially if you're a homeowner in Canada, because if you have a mortgage or you need a mortgage or you are getting a mortgage shortly, it's really important just to stay on top of where rates are going so you can manage your renewals. And when your mortgage renewal does come in, how are you going to work on making sure you're prepared to manage all of that? So thanks for joining me today. This is episode 159, and just getting into how rates are going to be. What I'm seeing is totally different than what was just a few months ago. And one of the things I'm chatting about today is some comments I saw Jerome Powell make just a few weeks ago for the Fed decision in the United States with regards to interest rate policy. One of those comments that Jerome Powell made during the speech there when the Fed was deciding whether or not they were going to raise rates in the United States or not, and that is that, first of all, they didn't increase rates, and people were shocked because inflation in the United States did go up 3% to 3.2% to 3.7%. So everyone was thinking like the US is for sure going to raise rates. But Jerome Powell instead made the comment saying that actually, we don't think we're going to increase rates right now. We may do one more increase in the future this year, but our policy right now is actually to keep rates higher for longer instead of raising aggressively to combat inflation, because inflation is proving to be very sticky, not going away. And that's evidenced by the fact that we're seeing that, in Canada, inflation was at 6.8% in November last year. We haven't hit that 2% mark in Canada that we've been aiming for. I mean, we came pretty close in June of 2023. We did come to 2.8%, which is why the Bank of Canada actually did a few rate pauses. But now that they are seeing that inflation is continuing to grow in Canada, now we're at 4%. The US is currently at 3.7%. Jerome Powell making the statement that rates will be higher for longer. And why do I want to bring this up? Well, a lot of my clients are in variable rates, waiting for rates to come down. I'm in a variable rate myself. A lot of clients are taking fixed rates right now that are 2-3 years long, anticipating that at that time rates will come down. Now, it still will possibly happen, but with these recent comments, I wanted to open it up for discussion to see what all of you guys are doing, and also let you guys know what I'm recommending to my clients. Because it's such a unknown at this point, and we are seeing inflation increase so much already this year, and that inflation is pretty sticky in Canada, it's really important to make sure that you're planning for the future. So if you have a renewal coming up in 1 or 2 or 3 years, you're going to want to make sure that you look at what your mortgage payment will be at today's rates and plan accordingly for that. Because if you don't, you could run into a situation where you thought rates are going to be down in 1 or 2 years, but they're not, and you haven't planned for that mortgage rate increase. With the rate rates right now, Jerome Powell making the statement just a few weeks ago that we're not going to increase rates, we're going to keep them where they are at for longer, that's a really concerning statement, and we should really plan accordingly to that. In Canada, we saw that Tiff Macklem did not increase rates, even though inflation went from 3.2 to to 3.7%. It's just crazy. Like, why did the rates not change? Why did the rates not change? Because inflation went from 3 to 3.2%. I'm not sure. And there's articles saying that Tiff Macklem almost raised rates in the last rate announcement, but instead kept them where they're at. So there still may be another rate increase on the next Bank of Canada meeting. Now, who here wants to know when the next Bank of Canada meeting is? Well, let's just take a look. The next one will be on. Let's see what we got here. October 25th. That's going to be a Wednesday. We'll be announcing that announcement right here on Canadian Mortgage Weekly, 10 a.m. on October 25th, Wednesday at 10 a.m. We'll be doing a pre-rate show as we usually do. I'll have my pet guinea pig mascot. Her name is Interest Rate. Try to predict interest rates again. We'll see where interest rates go. But again, getting back to that situation where rates are going to be higher for longer, it's important to know that where rates are right now, they could be there when you renew, and to plan accordingly for the renewal that you are about to experience. Now, whether or not you go fixed or variable, it's all dependent on when you renew. I mean, if we're seeing BMO say that interest rates are not coming down until, at least late 2024 in Canada, that is over a year from now, then what does that mean? We've even seen some articles saying 2026 in Canada. And there's a lot of articles saying 2026 in the United States as well, that rates are coming down. So where are we going from here? What are we supposed to do as homeowners? How are we supposed to manage all of this? What are my clients doing? What am I seeing that people are doing to manage these rate increases? And how are they preparing for the renewals? And how are they preparing if they want to upsize? Well, there's a couple things you can do today to kind of plan for the future. One thing, like I said, take today's mortgage payment, plug it into a calculator with today's mortgage balance, and see what your payment would be on your renewal based on your current amortization, right? If you can handle that payment, then you'll be fine. But if you can't handle that payment, this is how a lot of homeowners are battling the rising mortgage payments. One, they are trying to increase their amortization. And on their renewal, they're essentially taking their mortgage where it's at. Maybe you have 20 years remaining, and we're looking at increasing that to 30 years remaining, spreading out your payments for a longer period of time. Obviously, it's not ideal, but it leaves you in the driver's seat. And if you want to do any changes on your mortgage, you can obviously go back to your lender and put more money down on your mortgage or fast track your amortization at any point. But renewing with a longer amortization is allowing a lot of clients of mine right now to be able to stay in their homes at these higher interest rates. Number two, what people are doing to prepare for the higher rates for their renewal and the fact that rates are going to stay higher for longer is that they're getting side gigs, part-time jobs, side hustles. And if you already have a side hustle and you need another side hustle, well, that's really unfortunate because that's going to take up a lot of your time. But if you don't have a side hustle, here are some high side hustles people are doing to afford their mortgage. They're driving Uber, they're delivering skip the dishes. I see a lot of people doing part-time jobs in the evenings and weekends. A lot of people are asking for raises from their employers. And in Canada, that's what's happening right now. There's wage growth because employers are being forced to increase wages because of the higher cost of living. We're seeing a lot of strikes, a lot of unions go on strike. And this is all because wages need to go up. They haven't gone up in years. So as that's progressing, you could also make headway possibly with your employer or switch jobs to a different position that pays more in anticipation of your renewal coming up with higher mortgage payments. Obviously, no one wants to get higher mortgage payments. So what can we do to make these higher mortgage payments short-lived? Well, a lot of people, what they're doing is they're taking a variable rate mortgage on renewal, hoping that rates will come down and they will have that immediate benefit. And some other people, they want to lock it in, but not for the full 5 years, but maybe for 2 to 3 years. The important thing is that you want to really make sure that you're locking for a minimum amount of time right now, so you don't have to experience renewing into a higher rate, but that you actually renew into a lower rate. Because if you come up to a renewal and the rates are still high, then you may be faced with renewing for another 1 to 2 to 3 years at an even higher rate if we mistime that. So a lot of clients actually right now, what they're doing is they're seeing that rates are going to be longer, higher for longer, and they're locking in for 4 to 5 years at this point rather than the 2 to 3 years, just so they overshoot slightly. And when they renew, they are certain that they're back into an environment that will provide them with a more affordable interest rate and more competitive interest rate as well. So much so, actually, it's becoming a little bit of a pandemic. I'm seeing a lot of people that can't afford their homes currently, looking at selling and moving abroad, or selling and traveling, or selling and renting, or selling and just moving to a country that they've always wanted to live in, and moving forward with their plans because they think Canada is actually too expensive at this point. So makes sense. We have 1 million people coming into the country this year, and they all want to buy a home. It seems like a lot of these folks that are immigrating to Canada, they come with money in their pocket. They have a whole family with them, and they all are very motivated to buy a home, and they all get jobs, and they all go on the mortgage together, and they all buy the home together. So when you have 5 to 6 people on a mortgage that all have just immigrated to Canada, and they've sold everything in their home country, and they have a little bit of a down payment, it's really hard for that single or couple in Canada to be able to compete financially with the family with 5, 6 people on the mortgage wanting to buy that home. They can actually just afford that much more, and they don't mind all living together for an extended period of time, where a lot of people that are native to Canada, they want to be able to have their own space, not share with anyone else. And it's harder for those folks without the appropriate income to be able to get into that home and afford it without that extra income there to help them afford that home and qualify for it. And because of that, a lot of these people are facing renewals right now with higher mortgage payments. And because of those higher mortgage payments, they're having to, have extra support come into the house, or get a part-time job or a side hustle, something like that, just to help them with the mortgage expenses. So if you just joined me today, my name is Joe Bladek, episode 159. We're talking today about why rates are going to be longer for mortgages, higher for longer in mortgages. And this is all based on a few articles I've read and a comment that Jerome Powell made actually 2 weeks ago, saying that the reason that the U.S. is not raising inflation rates, raising mortgage rates any further, is because they feel they've done their job, and now that inflation is still not at 2%, what they want to do is keep rates at the level they are at now for longer in an anticipation of fighting inflation over the long term rather than the short term with aggressive rate hikes. It's a more passive approach to fighting a sticky inflation by keeping rates higher for longer. Interested to know your comments. Do you guys think that rates will be higher for longer? When do you think rates will come down? It's an interesting conundrum because it seems to have been a lot of folks have thought rates will come down end of 2023 or the beginning of 2024, including myself, from what I was reading a year and a half ago. And as things keep coming out, it seems like everything just keeps getting pushed back further. And that right now they're talking about rates coming down anytime between late 2024 and 2026. So it's almost that 1.5 year mark between the end of 2024 and the beginning of 2026. So Locking in right now for 1 year will take you to the middle of 2024. Locking in for 2 years will take you to the middle of 2025. And locking for 3 years will take you to the middle of 2026, which is kind of where that spot is where a lot of people are saying rates will start coming down. So it's almost like 4 years right now will take you past that 2026 mark and into that lower rate territory. So locking in for 4 years might be the best solution at this point if you want to avoid risk at any cost, because you may miss the whole entire rates being high if you can wait that long. So, some interesting food for thought this morning as we chat about interest rates, where they're headed, and why they will be higher for longer. Interested to know your comments below if you feel rates will come down sooner. But as far as I'm concerned, I think rates will start to come down no earlier than the end of 2024 and possibly as long as 2026. And if you're in a variable rate mortgage like myself, it's important that you keep on top of that as much as possible to be able to manage your mortgage payments and make sure that you're managing your budget as much as you can, because those payments can get outrageous, especially as they keep rising with these interest rate announcements. So the next rate announcement is on October 25th, 2023. That's when I'll be joining you here live on Canadian Mortgage Weekly talking about the next interest rate announcement. Tiff Macklin will be coming on here talking about rates, where they are at. My prediction right now is based on where we are at. They will raise rates by 0.25%, with prime rate right now being at 7.20%. That would mean prime rate goes up to 7.45%. Some other information that I wanted to just share with you all today on Canadian Mortgage Weekly is the fact that the 5-year bond yield has been going up quite considerably these last few months, especially these last few weeks, 2-3 weeks. We've seen the bond yield increase another 0.30% since 2 weeks ago, bringing the current yield to 4.329%. And that is pushing fixed rates even higher this week. I've seen fixed rates in Canada climb past 6% with prime lenders. These are AAA bank lenders in Canada. It's the lowest mortgage you can get in Canada right now with a lot of these lenders. You got the big green, you got the big red. And with the mortgages being at 6% and up, it's making it really hard to qualify. And speaking of qualifying, we're seeing that because rates are now at 6% and up, the amount the stress test qualifies you at is even higher. Now, because the stress test takes into account your current interest rate plus 2%, if you're getting a rate of 6% today, you have to qualify at 6 plus 2, 8%. 8%. It's just crazy how high these mortgage payments are. Is the stress test still an important metric in mortgage qualifying? Should we still be using the stress test? I mean, if rates go up any higher, we're approaching 10% qualifying rate. So TD, for example, their rates are around 6.5% right now. So if you're qualifying with TD, you're qualifying at 8.5%. It's so hard to qualify for this amount of mortgage, for any amount of mortgage, when you're looking at paying 8.5%. I feel this is really also going to slow the real estate market down quite considerably as these rates keep going higher, because for someone to actually qualify for a decent amount of money at 8.5%, you need to add like 5 people onto the mortgage. It's no longer just okay to have one cosigner. You need almost 2 cosigners, 3 cosigners. I've seen this a few times already. I did a mortgage actually for a couple. They have both a very good income. they bought a very modest priced home and they had to get 2 co-signers on their mortgage and they had great income. I just couldn't believe it. It was with a prime lender. We couldn't get around it. It's just rates are too high. Rates are too high. And the co-signers are just there to make sure that if these clients can't pay their mortgage, that they're going to step in to pay their mortgage. And oh man, it's so crazy to see how high these rates are going. All right, what's happening with unemployment? Because I know if unemployment starts to spike up in Canada, we should see rates come back down. Well, unemployment, no change the last month. It did go up slightly the month prior, and it did go up a little bit more before then. So with no change in unemployment just this past month, that's good news for the employment market, but bad news if you want interest rates to come down. Canadian inflation rate has gone up now to 4% as of August, up from 3.3% in July and up from 2.8% in June. Should see the new inflation numbers for September. They will come out on October 17. So that'll be just before the Bank of Canada interest rate announcement, probably about a week before. So it'll be interesting to see what happens with the inflation. I know that the forecasted inflation is that we are forecasting inflation to go from 4% to 4.5%. And if that happens, I can almost guarantee you today that we will see a rate increase by the Bank of Canada by 0.25%, another quarter percentage point. If that happens, oh man, that's going to drive rates up even further, unfortunately. And it's going to make it even that much harder for folks to qualify for any amount of home. Does this mean real estate prices will come down? Only time will tell. What do you guys think? Okay, US inflation, it's been going up as well. Not as quickly as Canadian inflation. That might be because the US did a extra rate hike in the fall so far versus Canada. Late summer. We have inflation in the United States sitting at 3.7%, up from 3.2% in July and 3% in June. The average Canadian house price down to $650,140. That represents a 3% decrease change from the month prior. And the month prior to that, we saw a 6% drop. So going into this fall market, we did see real estate prices drop. It'll be interesting to note if real estate does pick up because of these drops, or if buyers will not enter the market still because of interest rates. If you're a potential buyer, are you looking at entering the market right now? And if not, I'm really interested to hear why you're waiting and what you're waiting for. Are you waiting for prices to drop? If you are waiting for prices to drop, by how much more do you want them to drop by? They've already dropped by 30% approximately since the high point in February. Do you want them to drop any more? Is that even possible? Or are you waiting for interest rates to come down? One of those two things have to kind of break for a lot of people to get in the market right now. Otherwise, I see both camps sitting tight, waiting to see the next move. What's the interbank rate at? And why do I cover the interbank rate? Well, the CDOR rate does give us a good idea of how competitive the variable rate options are in Canada. And right now, with the CDOR rate sitting at 5.51% and the prime rate sitting at 7.2%, and the variance between the two being less than 2%, I'm seeing that the variable rate currently is not a competitive option. Although some people are starting to take a variable rate more so than others, because we are seeing a lot of folks want to experience the rate drops immediately as soon as rates do come back down. And these folks are thinking that the rate increases are, for the most part, done. All right. What else is happening? Well, we have that Bank of Canada rate announcement October 25th. And if you're just joining me now, we did talk about how interest rates for mortgages in Canada are potentially going to be higher for longer. And a little bit about that, you can either rewind and watch the beginning of the video, or I'll cover off a little bit of a summary here as well. Jerome Powell did say that they are not increasing rates in the United States because rates are quite high as they are. And with inflation being pretty sticky, that inflation will be battled by keeping rates higher for longer. And in Canada, we saw a similar move done by Tiff Macklem. He did not increase rates last Bank of Canada meeting. Rates did stay where they are at. And because of that, we did see the same strategy employed, with rates being forecasted to be higher for longer. And for that reason, some people, they're taking variable rates because they think that rates are where as high as they are for the time being, and the only place they have to go is either staying where they are at or going down. The other camp, they're locking in now for 5 years instead of 2 to 3 because they don't want to renew in 3 years when rates are potentially still high, and take the risk of renewing potentially at a higher rate versus the current 5-year fixed for the next 5 years. And then kind of coming in on the other side of 2026, 2027, when a lot of articles are saying that rates will then at that point start to come down. So you want to plan accordingly. If you haven't spoken to your mortgage professional yet, and you're looking at making some changes on your mortgage or moving, make sure you talk to your mortgage professional. If you're looking at moving and upsizing during this market, it's actually a good way to do that because with rates being so high, it's less competitive now to get into that larger home for a lot of new buyers. But for a lot of existing homeowners, it's actually easier to get into that upsized home. The reason being is because a lot of these buyers that own a home right now have a low interest rate on their existing home. So by blending their low interest rate with any new money that homeowner needs to borrow to get into that upsized home, they're going to be able to move that existing interest rate to that new home, essentially being able to qualify for that new home virtually the same as they did 3-4 years ago without these higher interest rates, and just blending the new rate on their new home. The caveat is you will have to be able to sustain a higher mortgage once that mortgage does renew, because that blended rate will only last until the end of your term. And then after your term is done, you'll have to renew into the current rates, which could be 6-7% by that time. So it's really interesting to see how people are going to handle this. I am seeing a lot of people upsize right now before their mortgage renews so they can get into that higher priced home and still qualify for it before rates go up. And if that's your situation and you're looking to upsize before your mortgage renews, it's actually a good way to qualify for more money before your mortgage renews, and then you're qualifying for less money. But when all these mortgages do renew, people won't be able to qualify for these higher priced homes. So maybe house prices will come down after all. It's hard to say. It's all a gamble. It's all a bet. We actually don't know anything, and we're all just speculating, right? Even though I've been in the industry now for 13 years, it's really hard to speculate correctly because, sometimes we speculate and we get it right, and sometimes we speculate and we get it absolutely wrong. So if you're looking to make any changes on your mortgage and you need a broker, feel free to contact me. I'm Joe Bladek. I've been in the business now for 13 years. I like to help people on their mortgages. If you're looking for some advice and you have your mortgage professional already, make sure you reach out to them directly and they can help answer any of your questions. If you have questions for me, feel free to send me a direct message or an email or call me. Schedule a time to speak with me. I'd be happy to go over your mortgage with you. And thanks again for watching Canadian Mortgage Weekly. This is episode 159. We'll see you next week on episode 160. Big special episode for Canadian Mortgage Weekly. That will be coming up here in October. We'll have that episode airing live October 5th at 11:30 a.m. And this is Joe Bladdock signing off for now. Thanks for joining me. We'll see you next time.